Welcome to Exiles Market. Today we are covering option basics. In option trading, level one options is selling calls. Selling puts is level two because it carries significantly more risk. And that's what we are covering today. Now we're using Robinhood for our demonstration, but every broker is going to have a trade options button. Click that, and that'll take you to a screen that looks very similar to this. Current stock price is going to be shown here in the middle. We're using PaySafe, $23.25. You're going to have buy and sell buttons somewhere, usually at the top. You're going to be able to select either a call or a put contract. There's always going to be an expiration date, and click this. You can see the different expiration dates that are available. You're going to have the strike price over here on the left, and you're going to have the cost, the premium of the option around here somewhere. Now, in general, the further that you go out in expiration, the higher the premium is going to be on the contract. We take a look at, say, April 17th, you'll see that the premiums are significantly higher here. Now, I've already made a video explaining calls, and I've put the link to that video in the description. And in my call video, I showed buying and selling calls in separate examples. But for puts, I think it's going to be easier to view them side by side. So instead of looking at Robinhood here, let's take a look at our spreadsheet. For our example, I'm going to be selling a put, and you're going to be buying a put. We're going to use stock XYZ. The current price of XYZ stock is $10 listed here. And we're going to be looking at the strike price of 9. Now, this particular contract right now, let's just say has a cost of 35. All right, when buying a put, you're opening a contract that gives you the right, but not the obligation, to force a sale of stock at this strike price. For having this right to decide, you're going to pay a fee. That's the premium, and you're going to pay that premium to the seller, me. And if you're thinking, wait, I don't own the stock, how can I force a sale of stock? Well, that's because you're going to buy it at market price. And here's how that breaks down. Okay, you're going to pay that $35 up front now you to open up the contract. And then let's say that the price of XYZ moves down to $8. That's good for you. That's what you want. You want the price of XYZ to go down. After that price goes down to $8, you're going to exercise your position. You're going to assign these shares to me. How are you going to assign those? What you're going to do is you're going to buy XYZ at the current price, $8, and that is going to cost you $800. Then you're going to turn around and sell that stock to me for $900. Because remember, you're buying this, I'm selling it. I've agreed to buy it at the at the strike price, $9. So you're going to force this sale onto me for $900. That's going to net you $100, the difference between what you bought and sold it as, minus the $35, because that's what you paid to open up this contract, making you a profit of $65. Now, as you can see, the lower the price of XYZ goes, the more money you're going to make. Imagine if the stock price of XYZ moved down to $7. If XYZ was at $7, then you buying it would buy it for 700 and you would sell it to me for 900 and that would make you $200 up front. Now, in exercising your position, most brokers will do this money back and forth for you. You don't actually have to give them $800 and then take the $900 back. You don't actually have to be a part of that transaction. Typically, your broker will handle that behind the scenes for you. Now, for me, let's reset this back to $10. For me, I'm selling the put. So I'm saying I will purchase the 100 shares of the stock at the strike price if this contract is exercised. And exercising means that the contract is enforced. I will be assigned the shares. And since I might be forced to buy these shares, I'm required to put the money up front. So if I sell this, I'm going to be required in my account to put up in collateral $900. Now, for this, what we've said before, I'm going to, this $35 that you are paying to open up the contract, I'm going to receive. So I'm going to be on the receiving end of that $35. Now, what I'm hoping for is I'm hoping for that the price of XYZ stays above this $9. If that happens, I keep the $35 and the contract expires worthless. Now, here comes the risk. Let's say the stock falls to zero. My initial loss is going to be $900, right? If this price goes to zero, I'm going to be forced to buy the stock at $9. I'm still going to keep the $35, and that's going to make an $865 loss for me. And that's why selling puts is level two. If you remember, when you sell a call, if you buy the stock at 10, you sell a covered call at 11, you can't lose money. Even if the stock rises to $1 million, your cost basis is 10, you sold the stock for 11. Sure, you missed out on making more, but you still made $1 per share. You didn't lose anything. Here, selling puts, you can lose up to what the strike price is minus the cost of the contract. Because remember, you receive that in premium and you get that. Now, flipping back to Robinhood, let's move this out of the way and let's take a look at Robinhood. It's important to note that you can click these rows. So looking at the strike price of 25, if I click this row, I will see some additional information here. The most important of this extra information are the Greeks: delta, gamma, theta, vega, and rho. I have a video on how the Greeks affect the contracts, and I've also put that in the description. Remember, this is just the basics. If you have questions, please leave them in the comments below, or come check out our Discord. We have 100,000 members, completely free to join, and myself and many other experienced traders are in there every day helping people level up their trading game. Thank you for watching, and I hope to see you in the next video.